A historic trade reset is unfolding. Washington and Beijing just hit the brakes on the world's most consequential tariff war. In a move that marks a significant de-escalation of trade tensions, President Donald Trump announced that the United States and China have reached an agreement to drastically reduce import tariffs. This development signals a potential end to one of the most economically disruptive phases of the US-China trade war, which has spanned over 5 years and affected hundreds of billions in cross-border trade. According to Trump's statement, both sides have agreed to roll back a substantial portion of the tariff barriers that have weighed heavily on global markets. While exact figures remain undisclosed in this initial briefing, the White House indicated that this rollback includes reductions across multiple categories of goods, ranging from industrial components to consumer electronics. This mutual concession reflects a rare moment of alignment between the two largest economies whose rivalry has reshaped global supply chains, triggered inflationary shocks, and forced multinational corporations to rewire their sourcing strategies. Analysts say the agreement could restore short-term confidence, but deeper structural issues remain unresolved. The timing is also strategic. Both governments are under domestic pressure, the US ahead of an election cycle and China facing a slowing economy. The tariff rollback may offer temporary relief, but it is not yet a structural solution. Markets are reacting positively, but cautiously. Tariff cuts are one side of the deal, but what did China commit to beyond the numbers? In a key concession during the US-China trade talks, President Trump emphasized that Beijing has agreed to eliminate a broad range of non-tariff barriers, signaling a potential shift in China's long-standing trade protection mechanisms. These include opaque regulatory hurdles, licensing delays, and restrictions on foreign ownership in critical sectors. According to the Trump administration, this commitment from China extends to increased market access for US goods and services, particularly in finance, agriculture, and digital commerce, areas long cited by American officials as being unfairly restricted. While previous pledges from Beijing often fell short in implementation, this round appears to involve concrete enforcement mechanisms. This move may also reflect internal pressures in China's economy. As growth slows and domestic consumption plateaus, opening the market to high-quality imports could help stabilize supply chains and offer Chinese consumers more choices, a politically palatable trade-off amid rising unemployment and weak business sentiment. For US exporters and multinational corporations, the potential payoff is significant, but questions remain about verification, enforcement, and whether these reforms will be durable or merely symbolic, especially in politically sensitive industries like tech, health, and energy. Access is expanding, but what about the hard numbers? Let's talk tariffs, fentanyl, and the math behind the deal. After a 2-day round of high-stakes negotiations in Switzerland, the United States has agreed to slash its average tariff rate on Chinese imports from a punitive 145% down to 30%. The rollback, announced jointly by both delegations, is one of the most dramatic tariff reductions since the trade war began, and it signals a calculated shift from confrontation to calibration. However, not all duties are disappearing. Roughly 20% of the remaining tariffs are still under negotiation, and they are linked to a far more sensitive issue: fentanyl. The synthetic opioid crisis, which has devastated communities across the US, has become a central sticking point in bilateral talks. Washington insists on binding commitments from Beijing to stem the flow of fentanyl precursors originating from China. While the tariff reprieve could ease inflationary pressures and offer relief to businesses reliant on Chinese imports, the partial hold on fentanyl-related duties underscores the growing overlap between trade policy and national security. Analysts warn that if no verifiable crackdown is enforced, tariffs may be reimposed under emergency powers. The numbers may look promising, but they are far from final. The fentanyl-linked 20% could become a political flashpoint ahead of US elections, with both parties under pressure to show toughness on synthetic drug enforcement. But even major cuts need time to take hold. What happens in the next 90 days will determine whether this truce becomes a turning point or just a pause. As part of the latest accord, Washington and Beijing have agreed to a temporary 90-day suspension of further trade escalation, a tactical ceasefire that opens the door to extended negotiations. Officials on both sides have framed the move as a chance to pursue what they term a comprehensive reset in bilateral economic relations. But this is not a resolution. It's a reprieve. The agreement does not eliminate existing tensions. Rather, it freezes them. Analysts describe the window as both a diplomatic breather and a strategic test. If progress is made, it could lay the groundwork for durable frameworks. If not, tariffs and hostilities may return with greater force. The 90-day clock reflects deep mutual distrust. While public statements from both capitals emphasize cooperation, internal briefings suggest that negotiators expect contentious debates ahead, particularly over intellectual property, industrial policy and enforcement. Markets, meanwhile, are treating the pause with guarded optimism. Equities have rebounded, but currency and bond markets suggest investors are hedging for volatility. For multinational corporations, the pause offers operational clarity, but not long-term confidence. So what's the bigger picture for China? Let's break down the three core wins Beijing just secured in this deal. As the 90-day truce clock begins, China emerges from the negotiation table with more than just temporary relief. It walks away with three clear victories that reshape the tone, structure, and substance of bilateral trade relations. First, a decisive cut in tariffs, not only easing immediate pressure on Chinese exporters, but also signaling to global markets that Washington is recalibrating rather than escalating. Second, a formal nod to mutual respect. After years of asymmetric language in trade talks, the inclusion of this phrase in joint statements offers China rhetorical parity, critical for domestic messaging and global posture. Third, a structural breakthrough. The US has appointed Scott Bessent as sole lead negotiator. This simplifies communications and reduces internal contradiction on the American side, a chronic source of friction in past rounds. Collectively, these wins grant Beijing a stronger hand as the 90-day dialogue continues, reframing the relationship from confrontation to managed recalibration. At least for now. Strategic wins are one thing, but what really matters now is how the markets vote. Let's track the global reaction. In the immediate aftermath of the US-China trade truce, global markets surged, with Asian equities leading the rally. Benchmarks in Tokyo, Shanghai, and Hong Kong posted gains of 2 to 4%, while US indices followed with intraday highs. It was a clear sign that investors, battered by years of tariff risk, welcomed the pause. Volatility also receded sharply. The CBOE Volatility Index, VIX, often referred to as the market's fear gauge, dropped below 20, a psychological threshold that signals decreasing anxiety over near-term macro shocks. This reaction isn't just sentiment-driven. It's structural. For months, hedge funds and institutional investors had priced in worst-case scenarios around tariff escalation and supply chain disruption. The 90-day truce, while temporary, removes a key overhang from risk models, freeing up capital for short-term reallocation. Asia's outperformance also reflects its direct exposure to trade flows. Export-heavy economies like South Korea and Taiwan rebounded sharply, while Chinese tech and logistics firms posted double-digit rallies. Still, analysts warn that this relief rally may be short-lived if structural issues are not addressed during the 90-day window. But for now, markets are breathing easier. Markets aren't the only ones reacting. China's central bank just made a quiet but powerful move on currency. In a calculated response to the easing of trade tensions, the People's Bank of China, PBOC, set the yuan's daily reference rate at its strongest level in 5 weeks. The signal was clear. Beijing is allowing, and perhaps encouraging, a stronger RMB to reflect improved sentiment and global confidence. The yuan's appreciation comes just days after the US-China trade pause was announced, reinforcing the narrative that China is moving to stabilize capital flows and reduce expectations of competitive devaluation. The fixing move was subtle, but in currency markets, subtlety signals intent. Analysts say the central bank's action also helps deter speculative outflows. In the past, trade uncertainty often fueled capital flight, putting downward pressure on the yuan. By reinforcing RMB strength now, the PBOC sends a message of control and macroeconomic confidence, both to foreign investors and domestic markets. The stronger yuan may also serve a broader strategic goal, demonstrating China's financial stability at a time when Beijing is expanding its commercial ties in Latin America and other emerging markets, aiming to project monetary credibility beyond the US deal itself. But a stronger yuan isn't the whole story. China may now be racing the clock, front-loading exports before the next deadline hits. With tariffs temporarily lowered and a 90-day negotiation window in place, market participants are increasingly concerned about a sharp, short-term export surge from China. A classic front-loading maneuver to lock in gains before trade terms potentially shift again. Exporters are likely to accelerate shipments of goods typically bound for the year-end US retail cycle, electronics, toys, holiday decor, while tariff relief remains active. This tactical flood of exports may temporarily boost industrial output and logistics revenues, but distort trade data and corporate earnings visibility into early 2026. Such front-loading is not new. During the 2018 to 2019 phases of the US-China trade war, similar behavior drove artificial spikes in exports, followed by deep contractions. Hedge funds and equity analysts are now factoring these distortions into Q4 earnings projections and warning about inventory overhang risks come spring. In macro terms, this export wave could also weigh on Western inflation metrics, creating a short-term dip in import prices, only to snap back once the front-loading cycle ends. The underlying message: the 90-day pause may be buying time, but it's not neutral. It reshapes trade flows in real time. China isn't just hedging its exports, it's also hedging its partners. Let's turn to Beijing's pivot toward Latin America. While global markets digest the temporary calm in US-China relations, Beijing is quietly advancing a parallel strategy, diversifying its trade portfolio through deeper ties with Latin America, especially Brazil. This is not a reaction to the 90-day pause. It's a hedge against long-term geopolitical exposure. Brazil, with its vast commodity base and expanding consumer market, is emerging as China's anchor in the region. Recent agreements span agriculture, infrastructure, and digital trade, signaling a structural pivot. Trade volume between the two nations has already rebounded past pre-pandemic highs. This shift is about more than soybeans and steel. It's about strategic insulation. By embedding itself deeper into Latin American economies, China gains access to vital resources like lithium and rare earths, while reducing exposure to US sanctions, tariffs, or political volatility. In the context of the 90-day truce, this Latin American push gives China optionality. It can engage with Washington, but it's not waiting for it. The diversification effort underscores a broader play for global influence beyond just trade relief. And as China widens its trade footprint, Wall Street is paying attention. Major banks are now revising their China calls upward. In a sharp pivot from months of cautious sentiment, Nomura and Goldman Sachs have upgraded their outlooks on Chinese equities, citing structural momentum and improving macro signals. Nomura shifted from neutral to overweight, while Goldman forecasted a strengthening yuan, projecting the RMB to reach 7.00 per US dollar in coming months. The reassessment reflects both policy and positioning, with Beijing deepening trade ties beyond the US, re-engaging with global markets and signaling monetary stability through recent PBOC moves. Investors are recalibrating exposure. China's pivot toward Latin America and easing domestic regulation have added fuel to the call. The yuan upgrade by Goldman is especially notable. Just months ago, markets braced for further depreciation amid capital flight concerns. But recent fixing behavior by the PBOC and better-than-expected FX reserves have restored confidence, especially as China seeks monetary credibility on the global stage. While skepticism remains, particularly around enforcement of trade deals and geopolitical uncertainty, the shift from global banks signals a re-entry point for institutional capital. For portfolio managers who were underweight on China for most of 2024, the cost of staying out may now outweigh the risks of stepping back in. But optimism isn't universal. Some US companies are still grappling with what's left of the tariffs, and it's hitting their bottom lines. Even as optimism grows globally, US importers are still absorbing significant tariff burdens, with remaining duties ranging from 10% to 30% on a wide array of Chinese goods. For many companies, particularly in retail, manufacturing, and consumer electronics, these costs continue to weigh heavily on profit margins and earnings forecasts. The partial rollback, while welcomed, has not erased the cumulative cost structure many firms have built over 5 years of trade uncertainty. Margins remain compressed, particularly for firms with thin pricing power or heavy dependence on Chinese input materials. Equity markets have responded accordingly. While Chinese stocks are rebounding, select sectors in the US remain under pressure, especially small and mid-cap import-heavy names. Some analysts note that investors may be overpricing the short-term benefits of the truce and underestimating residual cost drag. The political optics also matter. As US elections approach, companies are wary of passing costs to consumers, yet unable to absorb them fully. This leaves pricing strategies and capex plans in limbo, a structural overhang on forward guidance. And as corporate margins tighten, the Fed is now reconsidering its next move. Could rate cuts be off the table, at least for now? Following the easing of US-China trade tensions and a rebound in equity markets, the Federal Reserve is signaling a shift in tone. Expectations for a July rate cut have been delayed to September, as new data points to a soft landing scenario rather than imminent recession. This policy recalibration comes amid improved financial conditions, tighter credit spreads, declining volatility, and stronger than expected consumer spending. The Fed now faces less pressure to act urgently, especially as inflation data remains above target but no longer accelerates. For risk assets, the delay has mixed implications. On one hand, the Fed's patience suggests confidence in economic resilience. On the other, it limits the tailwind that lower rates would have offered to rate-sensitive sectors like housing, small caps, and tech. The market narrative is evolving, from rate cuts to rescue growth, to no cut means no crash. This shift reflects a more balanced outlook and raises the stakes for September, where both macro data and political pressure will peak ahead of the US elections. And with the Fed staying cautious, investors are shifting their strategies away from hype and toward real value. As central banks turn more cautious and trade risks stabilize, investors are increasingly pivoting away from high beta plays toward value-driven, risk-moderated strategies. The rotation is sending capital flows toward markets with attractive valuations and improving macro tailwinds, particularly China, Japan, and Hong Kong. China, after years of underperformance, is regaining attention due to policy normalization, stronger FX signals, and favorable risk-reward asymmetry. Japan is benefiting from corporate governance reforms and a weaker yen, while Hong Kong remains a regional tech and finance gateway. Fund managers cite relative valuation as a key driver. Price-to-earnings ratios in Asia remain below historical averages, especially compared to stretched multiples in the US equity market. With the Fed pausing, interest rate differentials also favor selected Asian assets. More importantly, the new positioning reflects a shift in investor psychology, from chasing growth at any cost to securing downside protection with fundamental resilience. It's not just about upside, it's about staying liquid and rational in a post-stimulus world. But even with the rotation to value, not all investors are staying put. In fact, some in China are quietly cashing out. While foreign capital is pivoting back into Asia, domestic Chinese investors are quietly taking risk off the table, particularly in the Hong Kong stock market. Despite positive macro signals, profit-taking pressure has emerged sharply, especially in large-cap tech names. High-frequency trading data show a surge in mainland outflows via the Stock Connect channel, as retail and institutional players move to lock in gains. Analysts point to a growing divergence. While international investors see recovery potential, local sentiment remains cautious, shaped by regulatory memory and liquidity fatigue. Tech stocks have borne the brunt. Names like Tencent, Meituan, and Alibaba saw significant intraday drops following sharp gains last week. The rotation away from tech suggests lingering uncertainty about long-term policy clarity, despite broader market rebounds. Some experts argue this behavior reflects tactical caution rather than systemic pessimism, a hedge by local investors who've seen rallies fade before. In a market still navigating policy overhangs, domestic flows remain a sentiment litmus test. While investors reposition, China's top leadership is also reasserting its global narrative, starting with Latin America. In a high-profile address at the China-Latin America Cooperation Forum, President Xi Jinping called for deeper South-South solidarity, denounced economic protectionism, and announced that China will provide 66 billion yuan, $9.1 billion USD, in credit facilities to Latin American economies. The move comes as China seeks to expand its economic footprint beyond the US-centric global trade structure. The financing package includes preferential loans, export credit guarantees, and joint development funding aimed at infrastructure, energy, and fintech sectors across Brazil, Argentina, and Chile. Xi's speech delivered more than symbolism. By explicitly rejecting unilateralism and protectionism, Beijing is positioning itself as a defender of open trade, even as its Belt and Road 2.0 strategy evolves into a more targeted, high-leverage global investment campaign. The 66 billion yen commitment reinforces a key theme of China's foreign economic policy, reducing exposure to US pressure by building strategic partnerships in the global south. It's diplomacy by liquidity, and it reshapes global capital flows in subtle but powerful ways. From tariff cuts to credit diplomacy, this isn't just a trade thaw, it's a realignment of global economic influence. And the clock is still ticking.